Google just made one of the strangest AI chip deals of the year. Instead of simply agreeing to buy processors from Marvell, Google received the right to purchase nearly 59 million Marvell shares at $206.58 each. Exercising all of those warrants would cost about $12.2 billion. But the really important number is much larger. Most of those shares only vest if Google generates enormous amounts of custom chip revenue for Marvell, with the full structure corresponding to as much as $120 billion in cumulative revenue through fiscal 2033. Marvell shares jumped after the announcement, while Broadcom, Google's longtime custom chip partner, fell. At first glance, this looks like an investment deal. It is actually something much more strategic. Google is creating a financial incentive for Marvell to become a major supplier of the custom silicon surrounding its AI infrastructure, while Marvell is giving Google equity upside if that business reaches enormous scale. Google does not have to spend $120 billion. The figure is not a guaranteed order, but the structure shows how big both companies think the custom AI chip opportunity could become. To understand why Google would do this, start with Nvidia. Nvidia dominates AI computing because its GPUs combine powerful hardware with CUDA, networking, software libraries, and a mature developer ecosystem. For companies racing to build AI quickly, buying Nvidia can often be the easiest solution. But hyperscalers such as Google face a different economic problem. They operate data centers at enormous scale. Even a relatively small reduction in the cost of each AI calculation can eventually be worth billions of dollars. That is why Google began developing its own tensor processing units years ago. TPUs are custom accelerators designed specifically for machine learning workloads. Google can optimize them around its own software, data centers, models, and power constraints rather than paying for every capability built into a general-purpose GPU. As AI spending explodes, that advantage becomes more valuable. A company buying a few thousand accelerators may prefer flexibility. A company deploying hundreds of thousands, or potentially millions of chips, has a much stronger incentive to customize the hardware. But designing the accelerator is only one part of the problem. An AI system also needs networking chips, memory interfaces, storage controllers, optical connections, and specialized processors that move enormous quantities of information between accelerators. As models become larger, simply moving data can become one of the biggest limitations on performance. This is where Marvell has been quietly transforming its business. A decade ago, Marvell was much more diversified across storage, networking, consumer electronics, and other semiconductor markets. Today, data centers dominate the company. Marvell says data center revenue has grown from roughly $200 million a decade ago to more than $6 billion in fiscal 2026. Representing about 3/4 of company revenue. Its custom silicon business went from almost nothing to roughly 1/4 of data center revenue in only a few years. Google could push that transformation much further. Under the new agreement, Marvell will work on a broad portfolio of products connected to Google's AI infrastructure. Reuters reported that these include AI accelerators as well as storage, networking, memory interface, and near-memory computing products. This means Marvell is not merely competing for one chip inside a server. It is positioning itself across the system surrounding Google's TPUs. The warrant reveals how the incentives work. Google can acquire up to 58.97 million Marvell shares at $206.58 each. A relatively small portion vests over time, while most of the shares are tied to performance. Reuters and other reports indicate the performance-based portion vests as Google generates custom product revenue from Marvell through fiscal 2033. If the relationship reaches the highest revenue milestones, Google gains access to the full equity package. This creates a powerful alignment. If Google buys only a modest amount of hardware, Marvell does not give away most of the equity. But if Google turns Marvell into a supplier generating tens of billions of dollars in revenue, Google earns a valuable stake in the company, helping reduce its AI infrastructure costs. It is almost like Google saying, if we make you dramatically bigger, we want to participate in the value we helped create. For Marvell, the trade-off could easily be worth it. Its entire fiscal 2026 revenue was about $8.2 billion. So a commercial relationship with an upper ceiling of $120 billion in cumulative revenue would be enormous compared with the company Marvell is today. Even if Google never comes close to the maximum, Winning a meaningful percentage of that opportunity could reshape Marvell's business. There is also a deeper reason Google wants another supplier: dependence. Broadcom has been one of Google's most important custom silicon partners and has played a major role in its TPU ecosystem. The new Marvell agreement immediately caused Broadcom shares to fall because investors feared Google might shift business away from it. But analysts cautioned that the deal does not necessarily mean Google is replacing Broadcom. AI demand is growing so quickly that Google may simply need multiple suppliers. That distinction matters. Google does not need to abandon Broadcom for Marvell to win. If Google's AI infrastructure doubles or triples, both suppliers could grow while Google gains bargaining power and reduces the risk of relying too heavily on one partner. This is becoming a common pattern across the AI industry. Hyperscalers increasingly want control over more of their supply chain. They design custom chips, diversify foundries, develop their own networking architectures, sign long-term power contracts, and build data centers directly. What once looked like a technology purchasing decision is becoming a strategic infrastructure decision. Google's goal is not simply to build a cheaper Nvidia competitor. It wants an AI computing platform optimized around Google. Gemini models can run on Google-designed accelerators. Google Cloud customers can rent TPU capacity. Networking can be customized around those accelerators. Memory and storage can be designed around the workloads Google expects. Software and hardware can evolve together. The more pieces Google controls, the less it has to accept the economics determined by outside suppliers. This is also why the Marvell deal could matter to Nvidia, even though Nvidia is not directly involved. Nvidia's greatest threat may not be one startup producing a faster GPU. It may be the largest AI customers gradually moving portions of their workloads onto custom silicon. Google, Amazon, Microsoft, and Meta all have incentives to do this. They spend so much on infrastructure that the return from designing specialized hardware can justify billions of dollars in development costs. If custom accelerators capture even part of inference, recommendation systems, internal AI workloads, or specialized training, Nvidia can continue growing while losing some of the market it might otherwise have captured. Google does not need its TPUs to destroy Nvidia. It only needs them to reduce how many Nvidia GPUs Google would have purchased without them. That is a much more realistic threat. Marvell is positioning itself as an arms dealer in that transition. Instead of competing directly with hyperscalers, it helps them build the custom chips they want. This can be an attractive business because each cloud company may want different architectures, yet very few have all the semiconductor expertise required to design every component themselves. Marvell can provide intellectual property, engineering teams, connectivity technology, packaging expertise, and relationships with manufacturers such as TSMC. The hyperscaler contributes its workload knowledge and system requirements. Together, they create chips that would not necessarily make sense as mass-market products, and Marvell is already benefiting from that model. Fiscal 2026 revenue rose 42% to $8.1 billion, driven partly by a 46% increase in data center sales. The company specifically attributed that growth to strong AI demand for custom products and electro-optics. Its first quarter of fiscal 2027 then produced record revenue of $2.40 billion and record operating cash flow of almost $639 million. Marvell has also been expanding its AI connectivity portfolio, including acquiring Celestial AI to strengthen its photonic interconnect technology. That last point becomes increasingly important as AI clusters grow. A single accelerator can be extraordinarily powerful, but modern AI systems may connect thousands of accelerators together. At that scale, communication becomes a major engineering problem. If processors spend too much time waiting for data from other processors or memory, expensive compute sits unused. This is why networking and optical connectivity can become almost as strategically important as the accelerator itself. Marvell argues that its opportunity now stretches from connections between data centers all the way down to connections between dies inside a package. Google is therefore not just betting on another chip designer, it is building a relationship with a company that can help optimize the entire flow of information around AI compute. But the deal has significant risks. The first is that $120 billion is an upper limit implied by the incentive structure, not guaranteed revenue. Headlines can easily make the agreement sound like Google placed a $120 billion purchase order. It did not. Google must actually buy qualifying products for most of the warrants to vest. If technologies change, if Marvell fails to execute, or if Google chooses alternative suppliers, actual revenue could be dramatically lower. The second risk is dilution. If Google eventually exercises the entire warrant, Marvell would issue almost 59 million shares. Existing shareholders would own a smaller percentage of the company. The logic is that dilution would only become significant if Google had already generated enormous business for Marvell. But investors still have to consider that trade-off. The third risk is concentration. Landing Google could transform Marvell. But becoming too dependent on one hyperscaler also creates vulnerability. Google has enormous negotiating power and can switch spending between suppliers over time. And the fourth risk is technological change. Custom chips take years to develop. AI architectures are evolving much faster. Hardware optimized for today's models may not be ideal for what comes next. Yet the agreement still shows where the industry is moving. The first stage of the AI boom was dominated by general-purpose accelerators because everyone needed compute immediately. Nvidia had the best ecosystem and became the obvious supplier. The next stage is about optimization. Cloud companies are now asking how to reduce cost per token, electricity consumption, networking bottlenecks, memory costs, and dependence on a single vendor. At hyperscale, shaving even a few percentage points from those costs can justify building entire custom semiconductor programs. That is why a company like Marvell suddenly matters so much. Google is not merely buying chips. It is effectively giving Marvell the opportunity to become one of the industrial partners behind its long-term AI infrastructure, and Marvell is making an extraordinary bet in return. If Google helps generate enough business to transform the company, Google can become one of its largest shareholders. The $2 billion warrant gets the headline, but the real story is the potential $120 billion relationship behind it. Because the biggest challenge to Nvidia may not come from another Nvidia, it may come from the world's largest technology companies deciding that, at their scale, the cheapest AI chip is the one they design specifically for themselves.